Welcome to our presentation on the income statement. Today, we'll explore one of the most fundamental financial statements that helps us understand a company's financial performance and profitability over time. Our learning objectives are to first understand what information is reported on the income statement and how it is structured. Second, we'll learn how to measure a firm's profitability. And third, we'll discover how the income statement connects with the balance sheet to provide a more complete picture of a company's financial health. Let's start by recalling what we know about the balance sheet. The balance sheet reports a firm's assets, liabilities, and equity at a specific point in time. Think of it as a financial snapshot. Now, if a balance sheet is a snapshot in time, then the income statement is like the moving picture that connects these two snapshots. The income statement, along with the statement of cash flows, helps explain the changes in account balances over time. The income statement reports the revenue generated from the sales of products or services, and it also reports the costs of running the business as expenses. The purpose of an income statement is to determine a firm's profitability over a specified period by lining up revenues from sales with the expenses incurred to produce those sales. This is done through accrual-based accounting, where revenues are not cash, but represent sales recognized when earned, regardless of when payment is received. The matching principle is key here, as it aligns expenses with revenues during the same period. It's important to understand that earnings reported on the income statement are not cash, but rather a measure of profitability during a specific period. So what exactly is profitability? Profitability is defined as revenues minus expenses, or what is left over of the revenues after subtracting the expenses associated with earning those revenues. When revenues are greater than expenses, the firm has positive net income and is profitable. Conversely, when expenses are greater than revenues, the firm has negative net income or a net loss and is not profitable. Net income is an essential measure of profitability, but there are other ways to measure profitability, as we will see when we dive into the ways we can dissect the income statement to learn more about the profitability of different aspects of a firm. Another name for net income or net profit is earnings. So when you hear that a firm has an earnings announcement coming up, they are reporting the firm's profits and giving guidance on future profitability to shareholders and other stakeholders. Let's look at the structure of the income statement. There are essentially 6 line items on the income statement: revenues, cost of revenues, overhead operating expenses, interest expense, tax expense, and net income. Revenues are reported first on the top line and represent the income earned from sales of services or products. Below revenues, we subtract expenses beginning with the direct cost to earn those revenues, which is referred to as the cost of goods sold or cost of revenues. Then general operating expenses are subtracted. These expenses represent overhead expenses required to run the firm and will often be listed as selling, general, and administrative expenses. After all operating and other expenses are subtracted from the firm's revenues, the net income reported on the bottom line of the income statement represents the profit of the firm. Because you will hear items on the income statement referred to in different ways, let's clarify some important terminology. The term sales is the same as revenues, and both refer to the top line of the income statement. Net income is the bottom line and represents the earnings or profits of the firm over a period of time. The income statement is divided into 2 main sections. The top half contains a firm's operating income, while the bottom part contains expenses related to the firm's financial and tax structure. Now let's walk through the flow of the income statement. We start with sales and subtract cost of goods sold to get gross profit. From gross profit, we subtract operating expenses to arrive at operating profit. Next, we subtract interest expenses from operating profit to get pre-tax profit. Finally, we subtract income tax expenses from pre-tax profit to arrive at net income. This cascading structure helps us understand profitability at different levels of the business. There are several important profitability measures you should know. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and it serves as a proxy for cash from operations. EBIT, or earnings before interest and taxes, is referred to as operating income because it reflects the amount of earnings a company generates from its operations. This is the amount of profit a company has before paying any interest, which is a financing cost, and then taxes. Interest expense is subtracted from EBIT and reduces the taxable earnings of the firm. After interest is expensed, the tax liability is assessed on the earnings before tax, or EBT. The income statement has important connections with the balance sheet through earnings and depreciation. Earnings that are not paid out are added to the equity section of the balance sheet. Meanwhile, the depreciation expense that is subtracted on the income statement is added or accumulated in the accumulated depreciation account on the balance sheet. These connections show how the two financial statements work together. As a company generates net profits over its lifetime, those profits flow from the income statement into the retained earnings account on the balance sheet. Some firms make distributions to shareholders in the form of dividends, which are taken from retained earnings. What is not distributed is kept or retained, hence the term retained earnings. This account represents the cumulative profits that have been reinvested in the business rather than distributed to shareholders. Let's review what we've covered today. We've learned what information is reported on the income statement and how it is structured, from the top line revenues down to the bottom line net income. We've explored various measures of profitability, including gross profit or gross income, operating income or EBIT, and net income or earnings. And we've examined the connections with the balance sheet through the earnings account and depreciation. Understanding these concepts is essential for analyzing a company's financial performance and making informed business decisions.